Hi, my name is Zsolt Miklósvölgyi, and I am the co-curator of the exhibition at the Kunsthalle Exnerstraße in Wien, entitled Leaning on the Past, Working on the Future, together with Hunya Christina from Berlin. And today we are now about to record a talk together with Gerald Nestler and Daniel Hüttler. Gerald Nestler is a Vienna-based artist. Daniel Hüttler is also an artist based in Vienna. And the whole talk would be about the, so to speak, theoretical background of the exhibition we were about to make in the context of Kunsthalle Exnerstraße, but unfortunately we didn't have the chance because of the coronavirus, and therefore we put everything online. So please make sure to visit wuk.at for our project. And now I would like to ask Gerald and Daniel to say hello for the audience. And please briefly introduce yourselves, and please also make sure to address how and in which terms you are working on the topic of future and futurities.
Well, I think I'll start to make a short introduction. I'm Daniel Hüttler. I'm working in Vienna together with a collective called the Adaptive Collective, and we organize reading groups and different topics. And I don't know, I think maybe you should work more on the terms of futurities, because we are more like not working on specific topics, but more like a alliance network or something like this, I would describe it. But please, you work on the term of futurities.
So my name is Gerald Nestler. I'm an artist and writer, and I actually also collaborate a lot with other people, mostly with my partner Sylvia Eckermann, who can't be with us right now, but here is a work of hers, so she's somehow with us at least. There is some specific kind of trajectory of work that I guess I should refer to, because that's like what I've been doing for over 20 years, more or less, is that I've been researching finance, derivative finance, algorithmic finance, etc., and other data-driven fields, because I wanted to understand like how they impact societies, how they impact kind of the production of subjectivity, things like this. And it started, to give it just a little bit of context, in the rather early 1990s, when I finished painting studies at the Academy of Fine Art and went directly into media art, because I thought that what was happening with something that was super new, which was called the internet, was really, really interesting, and it completely took me off painting, and I've never painted anything anymore. That was the old time. It was before the World Wide Web, which means it was all DOS, and it was really interesting working with groups then, the thing Vienna, Hilus and others. We did kind of like one of the first kind of congregations and conferences called Unit N at WUK then, and during the time when the World Wide Web was coming along, to me it felt like this is not just a new thing for artists, theoreticians, science and so on, but it's going to be a really big social kind of moment. And as a social moment, it's going to be sort of economic, it's going to be a market. And that somehow got me to the point that I felt that, at least me, if I don't understand what markets are, or how this kind of field of finance operates, I wouldn't actually be able to ask the questions that I thought are really, really important at the moment of time. So I had no really idea what to do about it. I didn't want to study economics, because I thought that's, you can read books, why economics? And as an artist, I wanted to do something where I experienced the thing itself and also experience what it does on me. So what I did, I started to work as a broker and trader, and did that for nearly 3 years. That was from 1994 to 1997. That was really kind of like in the boom of the sort of new economy, very speculative times, etc. Everyone who saw The Wolf of Wall Street gets an idea of what it's like, or what it was like. But that kind of like was my personal introduction to the field, and I realized that it's something that's so intense that it's going to probably take quite some time for me to kind of really get through it. Not just as an artist, but really kind of starting to go through it theoretically. and starts to write and things like that. I would have never expected it to, take so long and still being kind of completely in the middle of it. And also other data-driven fields by now, of course. But that's kind of like the context where, what I'm doing comes from, more or less.
Thank you very much. Before we are starting to talk, I would like to just also briefly address in general why we have thought that it would be fruitful to have a conversation with you in the context of the exhibition project online, leaning on the past, working on the future. First and foremost, I think it would be vital to start to somehow unfold the concept of time both in linear and non-linear terms, because if we see history, especially from the ancient Greek time, time became a mere linear concept throughout Christianity. And before that, there has been other concepts of time and therefore other concepts of futures. And for instance, if nowadays we are talking about a future that is nothing but the current time facing a catastrophe towards the future, well, this has meant completely different concepts in the ancient Greek time, because catastrophe as a word in itself has meant, the first part of the word kata means downwards in ancient Greek, whereas straphein or stropha means the turn or turnment. So it has rather been a process instead of a conclusion of a process. So, for instance, for Aristotle in the Poetics, he says that the catastrophe is a change in terms of a direction. But for him, the changing of a direction is a changing of the plot within a drama, for instance. And so after Aristotle, it became clear that catastrophe means a result and not so much of an event. So what is really interesting in this term that in this context it started to be as a term for poetics, and then it turned to be a theological concept. And nowadays, or during the modernity, it became a notion of natural sciences. So, for instance, if someone reads this super fascinating book of Eva Horn, who is a contemporary German literary theorist and cultural researcher, within her book entitled The Future as Catastrophe, she came up with the concept of the future that has been finished. In other words, the futurum perfectum. So for her, future is something what she calls in German Katastrophe ohne Ereignis. A catastrophe without an actual event. So my first question would be to you is, do you think nowadays we are in the need of new concepts that are going beyond the mere linear idea or understanding of time, and therefore future that is about to come? In other words, it's not present. It can haunt from the future. So future can haunt in the present, but it's not present in its actual sense. And how is it relates to the problem of finance and time?
I'm wondering if that isn't already here, I mean, fully, technologically, infrastructurally, etc. Because if you think about what derivatives are, what they do, in some sense, this might actually fit quite well to your description, because the derivative is something. You can talk about derivatives from different angles, different axes. You could talk about them in a legal manner because they're contracts. You can talk about them from a technological perspective, an algorithmic one, a formula, mathematically. But what they do is they are sort of a tool to deal with sort of the future at present. And there was sort of a necessity, in a sense, within the field, kind of, to come up with something like that. Another entry, actually, because I'm not sure if you're going to talk about that, so I'm just going to mention it in the beginning, is what there also are, and I think that's really important, and no one's really talking about that. They are metadata, and they are actually the first massively deployed and quantitatively exploited metadata in kind of like in the last 30 to 40 years. So when we talk about metadata, we talk about all kinds of things, but you usually talk about internet-related social media technocapitalism, but it starts in the early 1970s with derivatives, actually. But the point is, there was a catastrophe, and that catastrophe, in a sense, happened in 1973. That was the end of the world order as we have known it, at least in the West, because that was the end of Bretton Woods. When the Americans stepped out of it, out of different reasons we can discuss if you like, but they couldn't keep up kind of like the binding to the gold and dollar fix. No? So they stepped out of that. And what this meant is that this nicely regulated kind of international system where all kinds of national economies and currencies were sort of related to each other, went poof, right? So, in the terms that are used, currencies were floated, which means now they were out in the market somewhere, moving around. And something appeared that was not much of a topic before, and was a topic from that very moment on, and that's called volatility. So volatility are all these kind of strange risks. So from one moment to the other, you had a very sort of linear system, quite fixed, quite clear, very negotiated, and it became completely non-linear and non-directional because no one knew where not just it was going, but anything within it would be going. No? So the complexity started quite on a massive scale. Then, of course, you had the climate crisis that came, and so on. And so you had the sort of catastrophe that in some sense was an event, but in some sense it was a non-event as well, because people they realized the climate thing and the oil crisis especially, but other things weren't really felt that much, no? But in some areas, the impact was massive. But interestingly, at that very moment, right when this happened, a formula came up, an economic, so to say, econometric formula, which is called Black-Scholes-Merton. And that allowed to sort of deal with this idea of understanding volatility. And volatility is, to keep it very simple now, is more or less another word for risk. That means, financial markets got a new tool how they could relate to risk, how they could deal with risk. And what is risk? And I think it's quite interesting to look at it from a perspective that's again kind of financial, economic, to stay within the context. In the 1920s, a book appeared that became really important by a guy called Knight, and it's called Uncertainty, Risk, and Profit. And what he does, amongst other things, is he makes a very important distinction between uncertainty and risk. He says uncertainty is something we cannot know about. No, it's like unknown, like the future. We have no idea. No? Risk, in contrast, is sort of a quantitative way of speaking about the unknown, and we can say something about it. So somehow risk is a possibility to speak about the future. and negotiate the future, in a sense. No, and so to say, of course, there is profit within this sort of negotiation. No, so to keep it short, you could say that from that moment on, and there is an important scientific aspect within it too, which we can talk about if you like to. Financial markets became properly places of the production of risk. No, if you ask in a Marxist way, so to say, what's the mode of production? I would answer: markets, finance produces or is the mode of production of risk, but not in the sense of, oh my God, hazard and blah, whatever, but because the understanding of the Western world, of a, so to say, scientific or techno-scientific world, is that risk is the way that we can talk about the future. And that is what finance does. And in that instance, you have a complexities of different times, no? I mean, everyone usually refers to the idea of probability, which is very important in that, as sort of an array of past events that are looked at to be able to say something about future events, so to say. No? At the same time, with derivatives, that changes too, because it becomes a very stochastic model. So probability, of course, is important, but it uses random walk. It uses Brownian motion, which is a molecular sort of way of dealing with these things. So it is something that is completely in time, right? It's in the moment of time. It's not just the huge array of the past. So in a sense, you could say that finance dissolves, maybe even annihilates the past for different expectations of futures which come together at present and dissolve each other again and again. And the complexity would be that with every expectation that you have, and I think that's quite simple to understand for everyone, if we say tomorrow we expect the weather to be nice, that's not the end of it, no? It's not where we stop, because then actually that's only when we start to say, well, let's go swimming, or let's go to the Heuring in Vienna, or whatever. No, it's going to rain, we do this and then that. So one expectation makes the next expectation, so to say. And that's not very different. That's kind of like how derivatives operate, no? You have an expectation of something which instantly makes the next expectation happen. And that makes the field, the algo space, if you like, of complexity in derivatives, that there is a derivative on a derivative. Now we're still talking about the so-called vanilla derivatives, the simple derivatives, not the stuff that made the 2007 crisis. Okay, just the old school form. And through these kind of complexities that are negotiated massively all the time, you have sort of a time that evaporates, because it's always kind of at the next moment, but it has to evaporate again every instant.
And according to your understanding, at what point does this fascination of finance and the global market started with the concept of loving the risk?
Well, actually, you could go back really far, because I think that is an element. For me, this is a absolutely inherent element of Western civilization and capitalism. Because where does risk come from? Risk comes from the early time of capitalism, so proto-capitalist actually, when the first kind of mainly Italian, but also other, also northern German and so on, kind of ships were trying to get out and find new passages and find new goods and stuff like that. And of course, doing this was something that had a lot of hazard in it. No? And the word risk, riscare, relates not to the kind of like later shipping where you would go out on the sea and travel kind of like the seas, with goods and slaves and whatever, but where you navigated actually quite near to the coasts, where you never knew if there was a rock or something else in the way that would destroy the ship, which is a 100% catastrophe, right? A total event end. And that is the risk. So it starts right at the beginning, and it is included in everything since then. So I also think that there is a relation between in science, questions of risk. In art, I think it's, modern art is a risk-taking affair. I think that artists, in contrast maybe to people in business or in finance, what we very often do is we embody risk, actually, in a very, very intense, very real way. No, we don't hatch it in the classic ways or manage it in these ways. We are risk takers in the way of embodying risk. So risk is not it's not just a kind of a strange or bad idea. I think it can be a very good idea. It just depends on how we deal with it. So that's kind of like the start as an answer. But you wanted to ask something.
I wanted to ask how the term of venture capitalist or like venture capitalism like relates to this kind of risk surfing and risking it. Isn't it like this term like that totally embodies this kind of culture of risking, like investing in something that you know that won't give you any value, like
I think it's venture capitalists are actually, I mean, with a lot of capitalism and things like that, there's all this risk there's so much risk that they talk about, but they actually don't take very much risk at all, because they hatch it in every way, and even they use methods which are not that okay for venture capitalism is a high-end financing of ideas or buying them up. So that is kind of like something that's been around for 20 years, more or less, not before that. Yeah. It's actually since it's kind of like the new economy, the internet kind of way of doing business, what I call technocapitalism. Yeah. That's part of it.
Yeah, but it would be like totally not embodying, but maybe stealing the risk from the risk itself. No,
I don't know. This is not embodying risk. I mean, of course, there is this idea of the entrepreneur who somehow embodies the risk, but actually, usually they externalize a lot of that risk. Yeah. No? So I don't think that there is a relation to the artist, even if the whole idea of the new economy takes the artist as the proper kind of image. Representation and makes us into entrepreneurs, even if we want to be a person or not. So that is kind of a backlash in this sense. But the risk comes in where you have a moment. Sorry, there's something that's not so good. If whenever there is something unknown, wherever there is an expectation, there is risk. And in capitalism in itself, just imagine. Let's put it in a different way. We usually talk about value, and if you talk about finance, especially derivative finance, derivative finance is finance, because everything is underlying by the kind of negotiation of these metadata. There's another term I think it's really important: is price. Price is the quantitative way of valuing things, so to say. But in capitalism, value can only exist as something in the future. Value doesn't exist as something in the past. It's worthless. A past value has no meaning at all. Only a value only exists as an opportunity, a possibility, and a really good one for the future. And price is the language to talk about that. So you could say that in finance, you have no value exists in finance, only price. Finance annihilates value for price, because that is the quantitative way how they talk about value in the future, which is always somehow risky. So finance is nothing else but a way of trying to hedge and speculate and arbitrage these kind of uncertainties, these contingencies, which hold risk. So you can hedge, which means you manage risk. You speculate, which is you take risk because you think this is a good idea, or you arbitrage, which means it's a risk-neutral thing. And that is, for example, very important when we talk about HFTs, high-frequency trading, later, and how they make money, because it's a lot of arbitrage that they do.
And so in that sense, we can also talk about a time that is rather become more and more spatialized in a term of interconnecting different localities that has their own concept of time as well. And what I found really interesting in the concept of your work is, for instance, this problem of scalability in terms of time in finance, when you are dealing with such problems as light speed trading or high frequency trading or spread networks that are actually parallel with each other, competing. Technological telecommunication systems are parallel dealing with this issue, how to shorten and fasten the trading. Does this have to do also with the problem that it also produces inequalities between not only spaces and culture, but in different, let's say so, chronological regimes? So in different spaces where they have a different concept of time.
But I think what we are talking about, in a sense, is the effect or the reality of globalization. Because globalization is sort of a colonization of time. And I used to actually, in some texts some years ago, where I was writing about that, of the beginning of how the derivatives kind of came about, that, not just metaphorically, because I think there's more than a metaphor in that, is to say that the engineers of the time of progress that should have taken us out to the stars, to the cosmos, to the Hitchhiker's Guide of the Galaxy, and so on and on, in Star Trek. The engineers that should build the engines for the rockets to take us out there, after the end of that kind of utopia, we entered into a spatial dystopia, Blade Runner, and so on and on and on. But what we did not see is that there was a time-based utopia that was happening at the same time. You could say the engineers went from building rockets in space into rockets in time, and that are the derivatives. The derivatives are sort of colonization of time. They don't care about space. Now, of course, they care about it as a global situation in that sense, but that is their space. What they care about is time. How can we colonize time? So we have all those dystopian ideas and films from the 70s and the 80s on, but no one actually, or not many, look at what's happening within finance, which is colonizing time, on a massive scale. And that is something that happens because scientific discoveries, cybernetics, information computer sciences, etc., come together and form this sort of state-of-the-art thing. The derivatives are not just, they're not a crazy, weird way of capitalists trying to extract more money. They are a very smart way of extracting the money, so to say. But of course, the progress within that world, and also the technological progress, allows, or maybe not just allows, but makes it interesting within a competitive environment to find ever better ways of exploiting time and profit possibilities within it. So specific forms of automation begin to be really interesting, or hedge funds start to implement very early artificial intelligence programs, neural network programs, because one of the first ideas why they started doing that is that human beings are prone to error. So if you're able to get rid of human beings and automate what they do, you have, a lower error rate. And we shouldn't forget that the people in finance, we're not talking about people working in a bank, we're talking about mathematicians, all kinds of different scientists, etc., who actually make the space of finance work. They come from technology universities, technical schools, etc., etc. That is what feeds them, the quantitative analysts and the coders nowadays. That's the place, that's the people that feed the system. So automation starts to get rid of people, and then it becomes quicker and quicker. The point is, the more data extraction you can make, the tougher it becomes to make profit. I think it's very clear because the margins become ever smaller. So in a sense, one of the big topics of economic theory, efficiency, hits the wall at some moment, because efficiency would say that if the margins are so small that everyone gets the best price, then you have an efficient market. But at a specific moment when that happens, the margins become really small, no one makes profit anymore, and the price doesn't matter. So you have to find ways how you get around this problem. And that's what I call the hyper-competitive world that finance took us into, which we lived through because all internet businesses, platform capitalism, etc., are part of that kind of thing. So the speed problem or the latency problem is one of finding a niche to make a profit in an ever more competitive world. And this specific topic that you kind of addressed, high-frequency trading, interestingly actually started in a big way because of regulation. Because the American regulatory body wanted to have a fair market, because it was already kind of like, the differences in competencies and things like that were massive. So they wanted to have fair markets also for mom and pop investors, because in America, of course, everyone's invested in markets if they want to or not. You don't have a pension without it. It's a very capitalist system. So what they said is every asset has to have the same price wherever it's traded. Okay? That's a good idea, you would think, no? Because that means that wherever it's traded, same price. Now, what you have to do for that is what they call a consolidated tape. Consolidated tape. Which means, of course, if you're not a lawyer, but an engineer or technologist, you realize if everything has the same price, you have to communicate that price. And there's a problem. There's time or latency. So, the guys who were deep into automation and algorithmic markets realized they can be faster than a consolidated tape. And so they make free profit. And that's what we call arbitrage, in a sense. No, it's one way of arbitrage, means other things too, of course, but that is an arbitrage kind of thing. They were and I think this is the interesting part about these kind of complexities, that regulation made it possible. Regulation made it into this kind of big thing, because now everyone realized if we are faster than a consolidated tape, we just make money. We make tiny amounts, but if we have high volume, it's still a massive profit. So I think even in the high times of high frequency trading and these forms of algorithmic trading, the profits they made were relatively small compared to the whole market. But the volumes that they traded were incredible, because that was the only way that they could really successfully make money. So huge volume to make that kind of profit, and of course massive investment and of brain power and hardware and software into developing these kind of technologies that you are able to exploit latency. It's, because it speeds. There's no light speed trading, of course, because we're in a material world. There's always latency. Something's could make it slower than the light. So you have to fight against that. You have to find ways that you kind of dig yourself quicker through the materiality, in a sense. So they came up with all kinds of different ways. But I think there is some sort of a fascination, especially by kind of like colleagues, so left-orientated theorists, accelerationists, and people like that, with high-frequency trading and stuff like that. But this is just a small part of the finance world, and if you fix yourself to that, you don't understand anything about how finance works. It's just one kind of like, it's a niche. It's a really important one, an interesting one, of course, too. And it made people realize how technologically intensified finance is. But if you look at other places, or you look at the field itself, you will find out actually that there is much more to it. No, I mean, I would go so far to say, if you look at how, like this very famous book by Shoshana Zuboff, Surveillance Capitalism, where she talks about kind of like how data are exploited, to get behavioral knowledge, etc. And she talks a little bit also about finance and behavioral markets. That's what she calls it. But if you look at it, at least this is my perspective, and this is what I would say, is that this is part of what I call the derivative condition, because what they do, the business model that they use, is a derivative. What they do is, it's not just that they auction each kind of like, information click or whatever that you give. But the whole idea of how they relate to the future, of how they relate to the possibility to preempt what will happen, is the derivative mode. So even Google and Facebook are kind of like part of a derivative capitalist situation that allows them to survey in the first place. That's the business model in the background. So the technological, and I said in the beginning that derivatives are metadata. They're nothing else but metadata. They tell you how it moves, not that it goes like this or like that, but this kind of movement, for example. So, the relation in time of the fluctuation, that's a derivative.
The reason why I was also interested in asking you about how time became spatialized in terms of financial procedures or processes was also related to somehow to the concept of the revival of nationalisms, because to some degree the new forms of nationalist states are hybridizing this concept of relating to the past and also related to alternative futures, but at the same time are also participating in this ever accelerating and also immersing themselves into the ever fastening speed of global capitalism. So this kind of intertwining of these two concepts of time, where time is something that is rather relates to history, and history that is capable of being at least the monopoly of telling the story of history is capable of being exploited. And on the other hand, there is a global financial market which has a completely different set of rules, and they are starting to find their point of view or their niche on it in order to not only survive but also to somehow foster their economic growth. So the concept for me is the concept, what interests me is this kind of hybrid or this kind of intertwining between these two concepts of time.
I would like to differentiate
on the one hand,
of what you said before.
Yes,
about,
please.
And to me that is kind of like sort of a problem in accelerationism. It relates to speed, and speed to me is not much meaning. It's not very important. What's important is differentiation. On the one hand, because I think one of the problems of the left is how can they go on with critique, because critique is a form of differentiation that neoliberalism is nurturing neoliberalism. No? But on the other hand, because what to me is happening, at least from my reading, is that it's really important to understand two terms: volatility and leverage. If you look at, for example, because the most known examples is what Trump has been doing and what happened in Brexit, and if you look at it from this specific financial perspective that I'm offering, there's a specific escalation politics. Now, if you look at volatility, is something, as we said, which is risk. Okay, so you could have the idea to manage this risk and hedge yourself. Or you can also find out that if you escalate the risk, you take risk, but you produce a situation in which others actually get more risk out of that and you can gain. No? So producing volatility can become a massively profitable way. And that is something that spilled over from hedge fund worlds into politics some time ago. So if you look at what someone like Trump does, at least in my kind of terminology, he produces volatility. He surfs the wave of volatility. What that does is that whatever he says, it doesn't matter. He's always in front. He's always at the moment of attention. And everyone else They're starting to learn slowly, but in the beginning, everyone else would just go and say, hey, that's wrong. And they would continue the conversation without understanding that there is a logic of contingency that eradicates the logic of probability within that. Because the idea of probability is our idea of truth and fact. No? And if you produce volatility and you swing and surf on volatility, you don't care about that and you don't need to care about it. Because the next attention is the only thing that counts. And if you, on the other side, try to get into a discussion about fact, truth, probabilities, etc., you're completely lost. So the world of probability, the world of truth collapses. And I think this is something that, interestingly, right-wing politicians have learned much better and much more ruthlessly, that escalation, which is the production of volatility, gets them to that moment where they need to be, the moment of constant attention. And that is something that infiltrates to the people that they need, if they're voters, in the constituency or whatever. No? On a different level, you also have that in other forms of technocapitalism, in the way that Facebook and other kind of corporations and platforms operate with likes and stuff. No, it's a very similar kind of protocol that is happening there. So the idea that I don't think that a lot of these people actually, in any way, and I think you probably agree, believe in what they say. They just take whatever there is from sort of the past as a form of, a book of stories, a book of fairy tales or whatever. They just take what seems interesting in a moment and they just use it for whatever ways, but they just don't only use it like that, but they use it because they have a lot of people in the background who know how to technologically kind of infiltrate, and use data, exhaust, and so on for these kind of things, where they can actually put it to the right places. So they deepen the granularity of the messages, while on top, the surfing of volatility happens constantly, all the time. I think this is something that's been going on, and I think that, so to say, the left, whatever that is, would have to learn to produce volatility themselves, to escalate. Because nothing else would ever work, within, at least to my mind, in this respect, to kind of go against these kind of forms of politics.
Slowly approaching towards a conclusion, if a conclusion is ever possible, I would like to turn to Daniel and also ask his insight on whether art has a potential to come up with the new types of protocols Gerald was talking about. And for that regard, I would like to ask Daniel to explain a bit the concept of the Hungaro-futurist korona, which would be an alternative post-digital currency, and how it relates to other forms of artistic approaches towards new decentralized forms of financial strategies.
Well, this Hungaro-futurist korona is still kind of stuck exactly in this topic of protocols, like how to make these trade protocols, how to evaluate or let the value emerge from the protocols itself via like non-consumerist tactics, or like not trying to engage in this type of risk or speculation. Like there is no risk, no gain, more than just we're leaning much in the gamification of these trade protocols. But I don't know how much this could relate to the artistic practice. Like on the other hand, we, like at least in our collective, like our artistic practice has gone much more into kind of like a parallel academic way of meeting together and trying to also develop modes of learning together. And our last book has been like the Undercommons by Stefano Harni and Fred Moten, and we've been discussing a lot about this figure of the undercommons, which is like neither to be defined nor described, and they even say that you cannot even feel it. That it's more like a state of mind and like a state of action as well, like in being together, like in togetherness. So like this contingency probably like of these meta protocols that are not it's probably it's certainly utopia, no? Like it's metaphysical. Like what you were saying about how this crisis started with the dollar separating from the gold, and it's been a thing, like from my point of view, like a reduction of the material, no? Like always trying to be less and less material until you get to the metadata per se, like the thing. So if we can at least foster metadata that is in a way secured by these undercommons in the way of it's totally personal, but I think that could be a way. And maybe going back to this hoof corona, which is it resonates of course with the crisis we're undergoing now, the coronavirus crisis. But we were imagining of developing like 5 bills that could, like, that you would have access to by complying to the Hungaro-futurist ideology and trying to level up of the complexity of the ideology, and also having kind of understanding of the potential such a parallel ideology, like parallel identity, national identity could have for the big spectrum. So I think instead of addressing the masses because that's what you're saying. Like, I mean, if you want to fight populists, or like if you want to fight like hyper-capitalists, we should need to do like actions that level this up. Or like the left should also ride this wave of risk taking.
Yeah, they should. I think what they would need to know, because I actually never talked about leverage. Understand what leverage means and how you produce volatility. Yeah. You can do that in different ways. You don't have to, of course, you don't do it like right wings do it. Yeah. But you have to get out of this old scheme of probability into these other more contingent forms. Yeah,
yeah. And what we would like to do. I mean, like Zsolt, you are kind of also like a very important figure in this discourse of Hungaro-futurism. You know. Like this parallel identity of being Hungarian or like being Magyar, like I think through these protocols of learning and like being your own, or like not your own, but like a kind of a referent for a certain type of being in a community, like specialization in this sense of ideology would be very important. Like, yeah. But the question is still how to I mean, what's next? No? What's the action after it? Like, what do we do with these specializations? And if it's
because you mentioned Stefano and Fred, I know Stefano very well, and we have a late friend of both of us, Randy Martin. The way he talked about it was, let's try to find ways of sharing risk together. So, not taking risk and all these kind of things as the actual problem, but actually seeing it as the actual potential. And you talk about over-identification, and I use the word hyper-affirmation with my research on finance and kind of these kind of things. And I think that if you take the derivative mode in itself, it is something that is sort of a tool, technological, and so on, but it's not something that is totally meritocapitalism. You can take it away from that. You can take it to some other place. Randy actually did that too. And you can make it into a completely different system, which allows us to share risk and share abundance. That is a possibility. And if you look at the massive amounts of profits derivatives have created in the last 30 years for very, very few people, it would be crazy not to look into that, because that is a reality as well. No? So, I mean, actually we should more understand the what's in the back, philosophically, but also materially, and in the sense of operational things and practices, what volatility and leverage might allow us. And I think, can I say something which is a concrete point as an example? Because we've had the discussion on debt, of course. massively in the last 10 years. No, it's like the crisis, or 12 years by now, in a sense. No, and everyone's going kind of like into this debt and austerity topic. But I've never heard anyone speak about the situation that there's two forms of debt. There is the classical debt that we all know and that is put on people and also countries like Greece, etc. But there's another form of debt, and that is leverage. Leverage is a form of debt on the future that allows you to navigate the future. It even allows you to roll over, and if it becomes systemic problematic, you can externalize it. That's what happened in 2007, for example, in the crash. All the leverage was leveled and put away as debt to the people. Now, in a sense, you could even go as far, at least that's what I do, that what you do see here is the class system in technocapitalism. You have a leverage class. These are those who, by debt, can navigate the future, can hold the future in their hands, can preempt it sometimes even, because that is the whole idea of algorithmic automation, to try to preempt, right? And you have all those different tiers of debt classes, and there's every class system you have the lowest class who don't even get into debt, because they're not even part of that shitty exploitative system. So if we start to understand leverage as a possibility that can take us by different forms of, debts that we share together, that we collectivize, or that we give each other. No, it doesn't always have to be the whole collective. It can be things like this. It could be autonomies, but these autonomies could be contingent just for some time, and so on. No, if it's more something that can flow, and that is something we can do with decentralized systems. No, then I think we can develop forms that are really interesting, and I think the whole topic of decentralized currencies, for example, is really interesting. There's a lot of people working on that. Also in Europe, there's friends like Jaromil Vedine and other people who do that. There's even cities like Barcelona who are really getting into these kind of things, to do it on a municipal level. And because it's decentralized, it is, of course, an idea for smaller structures, municipalities, and these kind of places. But in a sense, what it does, it allows us to differentiate and leverage all the risks and opportunities and all the needs and desires in new and different ways by taking up and reorienting these technologies. So instead of kind of, thinking that they are bad or capital or whatever, we should learn to understand them and use them, and that, I think, is the way that you can go against the system. To me, there is not much of another way.
And in this discourse, how is it called? Your topic, or your resolution thing. I don't know how to say it, but here is, I think, where it comes into play. This revolutionizing the system from the inside, having an insight also how it works. And I think this is why conversations like this, with you at least, is very important to see, or to know how things work, and how these abstract things like derivatives, as you say, it's normally not something that you would discuss, but also introducing these topics and making it a bit more, I don't want to say democratic, but more accessible to to different modes of processing. No,
But the resolution thing, of course, is something that has which has another mode too, which is a more anarchist or more. To me, this is these are all very artistic approaches, and I come to these approaches because I'm an artist and not a sociologist and not an economist. Because art, the great thing about art is that it's postdisciplinary. It's not a discipline, but it can look at all the disciplines. No, so you can completely. I think the great thing about art is that you can get to other ways of looking, different access schemes, so to say. No, and one of the things, at least to me, is this idea of resolution came about for a project when I was part of forensic architecture. I did my PhD at Goldsmiths for the forensics exhibition at the HKW in Berlin. And I was looking at the flash crash, HFT, high frequency trading flash crash. And the interesting part about that, to me, because I'm an artist, is why does no one actually know what happened? And why do people look at things in so different ways? What are the aesthetics that are actually used? And if you look at it, you see that normally the chart that they look at, the map, so to say, is a 1 minute chart. Now imagine 1 minute in the world of high frequency trading. That is probably further, it's the difference between here and, a very remote star. It's immensely far. So even if you look at it on a map of 1 second, it's incredibly far. It's out there. You don't see nothing. So we are looking at a world where we don't see nothing. We are blind completely. Because what they're missing is the resolution. Now, in this crisis of the flash crash, there was one small company, a data provider, who collected all this data. So they had the data, they had the knowledge, kind of like how to deal with algorithms and bots. So they started to kind of like, if you like, build little time rockets to go into this kind of data. And then they started to detect things on a micro level, microsecond level. And then they looked deep, because this could be just some data dust and stuff like that. You don't know if that's something real or not. But then they looked more and more and more, and they realized, the more they looked, that that there were patterns. So that's not something by chance. No, this is not whatever, something that's just kind of like there, some weird data. But that there are patterns. So something happened. Someone did something. And then I thought, to me, now this is the next really interesting point about this term resolution. So it's not just like the term as we usually use it with the camera. Now, has it a higher resolution or a lower resolution? Even the way that science started in the West, with Galileo looking at the stars through a telescope, and that changed everything because the resolution was different. But at that moment, we have the resolution to say that it's there, and in science it would be enough because we would say, oh, we have a new star, we call it like this, and wonderful. But here, we just see something, it's a pattern, and we can name it, but who cares? Because we don't have access to the data. So the resolution is actually not there. So you realize resolution is not just you see better, it means cognition and knowledge production. And it also means decision making, because if you don't know what is there, you cannot decide on it. No? So actually resolution is the semantic field that's extremely interesting to activate something like transparency, which is super passive. Right? And in that research, the next point and final point, I hope, because I think we're overextending totally, was that even if you get all the data together, you would never be able to resolve the issue, and it has still not been resolved to the day, and it's 2010, it's 10 years now, because capitalist system is based on property. That means you have proprietary rights, which means no one can look into the actual owner of the data. So you don't know. No? So we're living in a system where resolution can never be attained. Transparency can never be attained. There's always another right that's higher up than that. No? So what that means, of course, to me, and that's also, I think, an artistic move, is to say, well, the only way then, if our whole system, our democratic system, our legal system, our policing system, whatever, are completely in non-transparent, in the most fundamental sense here, the only way that we can deal with it is by kind of doing something that no algorithm could ever do. Become a traitor. So finding people, either becoming yourself one if you're in such a position, or finding people that would start to speak out. Because all those places where this happens, they're not purely algorithmic, they're not automated, it's human beings. And it's a lot of human beings. So actually we're in a situation where we could resolve these problems easily if we get enough traitors to become educators. So people that start to disbelieve in their system, that start to stop their allegiance to the system, that start to realize that there is another allegiance that is much more important and much more wholeful and senseful and sensitive for them, and change, and start to kind of open the black box that is always closed. No? So you have this traitor educator figure, this kind of renegade, which I think is really, really important. And it also, in a sense, reformulates the idea of solidarity, because it's not this, again, this huge kind of global community that is sort of part of that solidarity, no? Which in such a differentiated system with today is sort of a nice idea, but very hard to get to. But it's something where people can actually have simple and direct forms of solidarity, because you can help someone who is in such a position very well. You can be someone who, if you are not in a position yourself to become a whistleblower or another kind of data activist who can actually do something, but you can, in whatever way, kind of support this and even protect it. So you can develop sort of a renegade activism that's very protective and very positive for this development, so to say. No? And this allows you then to decentralize as well, because what you do is something seemingly impossible. You punctuate the highly secured system of property, no? And that, I think, that is the moment when you can really decentralize.
So with all that in mind, I also would like to remind us all that even though Benjamin Franklin once said that time is money, there has also been a French philosopher, Jacques Derrida, who wrote an amazing piece of essay about time as gift. So I hereby would like to thank you in the name of the organizers of your time as a gift, which is unconditional, that you have devoted for the topic of our exhibition. And so thank you for taking your precious time to sharing all these thoughts. Thank you for Gerald Nestler and Daniel Hüttler for the amazing talk.